Welcome back to this very important pre-budget Indianomics. We have been discussing capital gains and other issues with three stalwarts, G. Mahalingam, Ananth Narayan and Srinivasan Varadarajan. Well, gentlemen, thank you very much for your patience. Mr. Mahalingam, the question that I raised before the break, from 1992, when we marketized the exchange rate, we have been, RBI has been on the assumption that 2 to 2.5% current account deficit is manageable with capital flows. One odd year like Lehman crisis, we may see an outflow, but otherwise we'll manage. That seems to be under threat now because we may be entering the third year of negative BOP. So do you think this requires some thought?
That's a very important question, Latha. But I have a slight different perspective on this. My feeling is that this 2 to 2.5 is something which perhaps has not undergone too much of a change. Okay. Thanks to the situation that is prevailing in the international markets and the global economies. India is still one of the fastest growing economies in the whole world. Indian macroeconomic parameters are still good. So I would still say, while we do see net FPI flows outside the country or the FDIs are not coming into the country in a big way, I think these are blips that we are facing because of a variety of factors that we have been actually, we are having on the table right now. So I am sure that if India can maintain this kind of a growth rate, India can maintain this kind of a strong macroeconomic parameters, eventually the foreign flows will actually gravitate towards India. But I'm not saying that we don't need to do anything because of that. We have to do a lot more things. I think I would first say ease of doing business is something where actually a lot more lip service is being done than what is being attempted. Today, if an FPI has to enter the country, the onboarding process, the way actually he's allowed to trade and all that, I think today we need to do a lot. We need to go several miles to make the whole thing much simpler. So given that, I would say that if we can create these hygiene factors around the people, foreign investors coming into the country, I am not really apprehensive about the flow reversal over a longish term period. And I would definitely call the present state as a kind of a blip. It's a one-off affair. And if we can maintain the whole thing in a strong condition, perhaps we'll get it back. It's not a problem at all. Okay. Thankfully, again, I would also look at this as a kind of an opportunity for us. We are now exploring other trade agreements. Maybe we are trying to now strike a deal with Europe. We are exploring newer markets abroad. So all these are, perhaps we would have been absolutely complacent. We would have been lazy. We would not have got into this had the political situation, the geopolitical situation did not dictate this at all. So I would consider this as a kind of a God-given opportunity for us to explore greater market. The last point is the rupee depreciation. I would say I'm not concerned about the rupee depreciation. Okay. I would say that actually, as long as it is on a trajectory which is reasonably, it's not a vertical fall like what happened in 2013. As long as it's a kind of a slow trajectory, I think it's fine, no problems at all. RBI is doing a fine job of stepping into the market and cushioning the fall. Okay. And this kind of a fall of the rupee is going to be actually a blessing in disguise for us, thanks to the oil prices. The oil prices stayed at benign levels for a considerably long time. And I expect that they may not, zoom through maybe in a short period of time. So we should look at this as an opportunity to reform ourselves, expand the markets, expand the trade agreements and all that, rather than trying to bother about the current account deficit. I personally feel the current account deficit is not.
I think the Reserve Bank governor will want me to headline everything you said, especially that we should not be worrying about the rupee depreciation. But yes, the pace is what we should be worried about. And also the fact that we reform under duress. 1991 also came because we had only 3 months or 3 weeks of dollars of oil imports. Srini, how would you advise?
I think we are in a transition, right? A nominal growth rate was possibly in the teens for a long time. And we are still anchored to the mid-teens as a growth trajectory for almost every corporate, for everything and whatever. And we claim our inflation is 2% and our nominal growth is in single digits. But we want all our metrics to be in mid-teens. What are expectations from corporates, what are expectations from everything else. So the whole thing is we need to sort of reset our own expectations. And that is what the market is doing today. It is moving, saying that India, whatever, forget the PE and the valuation metrics, your growth, nominal growth, you were in the teens. Now you are in double digit in a reasonable case. Meaning base case is double digit, not anywhere in the teens. And now that reset is what is happening. And the differential, the nominal growth differential between India and most of the other countries we are competing with is contracting. And therefore, they are
Our valuations also will contract.
And our competition will get more of the flows because the differential is contracting. So that is the adjustment which is happening in my view. It is not anything to do with anything else, because with the ease of doing business, I agree we should do. But if there are returns, people will go through whatever they have to go through for the return.
That's true.
It's just that there is a reset happening. And if we believe we are going to be an inflation economy which is less than 4%, our growth is broadly in the 6 to 7% range. So we are anchored around 10%.
10%.
So we are not in the teens. And that is the adjustment which is happening.
Which the FPIs are already making.
Yeah, everyone is doing it. If you look at earnings downgrades happening quarter on quarter, that is what is happening, right? Meaning everyone starts off with a higher number and then pulls it down. So banking credit growth can't be at 15%. If you do 10% nominal credit growth for banks, large banks, it's good. So there's a reset happening.
Of our macros.
Of our macros, which is in line with what actually happening in the underlying economy. So this can't be...
Yeah, we can't compare ourselves to the first decade or the second decade.
Yeah, 5 years back we were different, and today it is different. So that is what the adjustment which is happening. So we shouldn't be trying to sort of, we want low inflation, we want everything great, but we want our growth rates to be something else is difficult, right?
So out of time, last few...
I have a slightly different nuance to what Mr. Mahalingam and Srini said. I agree broadly with what they said, but there is also, I think, something for the budget to address, if not now, over a period of time, when it comes to capital flows. And that is the way in which we have capital gains tax on a source-based framework rather than a destination-based framework. Globally, OECD recommends, and most major markets follow a destination or residence-based framework, which means the investor is taxed at the location where they are based on all the income that they are registering. India, however, we have a source base, which is an aberration. It's not the norm across the countries.
So withholding tax has to go there.
Many investors, therefore, report that India is an outlier on account of this withholding tax, which creates a lot of problems on multiple counts. First, even though we have tax treaties, we still have withholding tax. Now, if I am an investor who's tax exempt in my residence, then actually having a withholding tax is money down the drain. Second, we have the way in which our withholding tax operates does not qualify for easy set-off in some jurisdictions. So actually they end up paying 2 times taxes, once here, once there, despite treaties. Finally, remember we calculate capital gains based on rupees. At a time when rupees depreciating, the amount of gain that has been computed for the investor is far higher than what their actual gains are in their home currency terms. Now, this is an aberration. So we have stayed with this. LTCG was brought back in 2018. My sense is over a period of time, we have to move towards a residence-based taxation. This is not exempting FPIs from taxation. You get taxed in your home country. Then the argument becomes, how is our LTC regime versus the LTC regime of other countries? I think this is an aberration. This is a serious feedback that has come both from FDI investors and FPI investors. And we have to, think very deeply about us being an aberration.
Okay. I have such a good panel over here. This should go on for an hour. Unfortunately, out of time. But this word will reach North Block and Mint Street and everyone who's making policy. That's it on this excellent edition of Indianomics. Thanks for watching.
Thank you.